Hi, Marty. Thank you so much. What a pleasure to be here. Thank you again for the opportunity. Gentlemen, welcome. We have such an amazing panel. It's just a wealth of knowledge. And we have a super interesting theme to focus on today, because as you know, with FinTech, we could be here all day, all week. So first of all, let me introduce the panelists. Many of you know Ron Divari. We've seen him around. Hello, Ron. How are you today?
How are you?
Hi.
Is that good or bad?
It's amazing. It's great. And Ron is actually my neighbor in New York City. So he is just an amazing, amazing panelist. We've been on many panels before. And actually, that goes for Daniel and for Andre as well. So Daniel McAvoy, you know him. He is the partner with Polsinelli. Daniel, your wealth of information on legal issues that seem to be surrounding FinTech increasingly more and more. Welcome today.
Thanks for the intro.
Thank you. And Andre Herrera is the Chief Compliance Officer. And this is the toughest job ever, as we know. This is the job that none of us could do anything in FinTech without, and it's completely thankless. So, Andre, welcome to the panel. It's so great to be on the same panel as you again. So we are going to delve into a little bit of the regulatory, forget a little bit, we're going to really delve into the regulatory environment that FinTech companies, both established banks and FinTech startups, find themselves in. And all of a sudden, it feels a lot like a regulatory war on innovation. And I heard this in a bank board meeting. But this is a sentiment that I've heard increasingly in many boardrooms and speaking to many management teams of FinTechs. So let me pose this question, and then I'll ask all of you to comment on it. What is your view on the regulatory environment? What is going on with the SEC? What are the proposed rules that could really impose significant obligations on FinTechs in terms of exchange registration, RIA supervision, etc.? So what do you see as the main trends in the regulatory environment? And I would like to start with Daniel, because I think he sees this in his day-to-day, right, increasingly more. So Daniel, please kick us off.
Well, and I think you know, even with that, it's like, wow, who knows? It seems like every other day there's a completely new thing that happens that blows up some part of the FinTech you know, ecosystem. And so obviously, whenever you have you know, any kind of crisis that tends to develop new laws, the legislature gets together, that's what spurs people along. But even before, like, you know, any of this kind of started, there's been just a very aggressive regulatory agenda coming from, you know, pretty much all of the regulators under this administration, but particularly the SEC, that has been, you know, so aggressive that they've actually had trouble retaining people, simply because there's so much stuff that they're trying to get through you know, in a very short period of time. Now, a lot of these things are, you know, things that very well could affect FinTechs should they go through, and can make life a lot more difficult depending on the type of FinTech company it is that you're working with. And so, for example, you know, something that's been, you know, pretty common within the FinTech industry is that if you're dealing with securities, that maybe you yourself don't have a broker-dealer license. Maybe if you're accepting payments, maybe you don't have a money transmission license. You're going through a bank, right? you're going through a registered broker dealer and you're kind of white labeling their back office and their compliance functions and stuff like that to go out there to the market. And so one of the big things that's changing, and this is a theme on things, platforms that sell securities. So this would be, I would say, targeting the stonks of the world, to force them to register as either broker dealers or exchanges. Also going after DeFi in that respect. And then another sort of theme overall has been, kind of additional monitoring and supervision, which could be a very good thing. And there are, people who are playing fast and loose, and there are people who are being, extremely compliant and careful. But but that is going to create definitely a different dynamic within the fintech community, because if you're working with an RIA, for example, as an administrator, even as whatever else, as an index provider, like that's something where now, like on an ongoing basis, if this rule passes, it would become an obligation of the investment advisor to actually monitor and oversee and make sure that they're following the same investment advisor rules that you are. And that's something that's been a big gap for a while.
Thank you. Andre, as a Chief Compliance Officer, first of all, tell us just a little bit about your firm, and how, because obviously the payment space is heavily impacted by regulation. So please tell us a little bit about the context, right, in which you operate, and what do you see as a Chief Compliance Officer? What are the trends that you see from inside a firm?
Absolutely. Great. Thank you. That's a great question. So I've been working in RegTechs and FinTechs for the last 9 years.
Yeah.
And for 8.5 years, or a little over 8.5 years, I was with a regulatory technology company that we specialized in the cannabis space and with money services businesses. And then just last month, I joined on with Juno as the Chief Compliance Officer of a crypto company. So I've gone from one hot issue, one hot area, to
Right.
another hot area. And I think I can make this comment, when you're saying that the regulatory environment is starting to get more difficult, even you start seeing things from the OCC. So the OCC is giving warnings that, if these fintechs are left unsupervised, that things are going to go crazy and that they're going to become a severe problem. And I think I agree with that. When I look at fintechs, a lot of these companies are so interested in building product, they don't think about the compliance side of the house. And so their product gets way ahead of the regulatory environment. And then either, you get like an FTX situation that comes on, or they start having problems with their sponsor banks. I know that was mentioned about money transmitter licenses and or using a bank sponsor. And so if you use a bank sponsor, to a certain extent, you're riding on their charter. But too many banks are coming out with banking as a service. And in that banking as a service model, it's almost like they're opening up their charter to these fintechs without the proper supervision of these fintechs. But you have ACHs and you have all the NACHA regulations. If you get involved in lending, well, lending has quite a few regulations in there as well. And so I think that compliance is normally not on the front of these fintechs' minds when it should be, because it's going to create a lot of problems and they're being reactive to all of these different situations, if they're not putting compliance in the forefront.
Thank you so much. Ron, we're gonna come to you for your view on the regulatory, what's being developing in the regulatory environment. And would you like to give us a brief overview of your investment in the payment space, or maybe anything else that you'd like to mention there, and talk about the trends that you see?
Thank you again. I think the comments that are made are pretty valid, but we live it as the chef in the kitchen, if you will, or the cook in the kitchen, meaning that we're putting dollars to work every day on fintech. So one of our primary focus, background-wise, I built out the structured finance business at BlackRock, and then in 2008, help to really try to identify and help very large institutions to figure out what just happened right in front of their eyes. So came to a conclusion that finance ultimately needs another BlackRock, and BlackRock is not going to be the one doing it because they're in investment world, rather than really in the operation of the embedded finance, if you will. And that's about 80% of the capital around the world that flows around every day from every single transaction. And NewOak Finance was created after what I considered lots of learning. Our friends were law firms, some of the largest firms, hired Capital to help out with some of these issues retroactively. And now we're trying to get ahead of that. And NewOak Finance has invested and built two B2B2C companies. One is trying to effectively eliminate interchange and eliminate any form of things like Pfizer, so effectively have full control from A to Z on consumer e-commerce lending. But with the difference that the approach that we took regulation as being the driver, as opposed to a afterthought. So we spent about 2 years, three banks taught how to do this. Frankly, they didn't know anything about revolving credit because they essentially they were not going to be balance sheeting it. So in the sponsors bank, they were okay with the term loans, but they had no idea what a revolving non-credit card, non-BIN thing would look like. And ultimately, we ended up with Cross River Bank that was willing to partner with us to lend their license. I always say the license. And by the way, it's not their license. It's really a bank is borrowing it from their regulators. So number one, we have to convince the bank you're working with that you're defending them and yourself, and you're not really just hastily going to the market and then finding out things in action there. So I have had so many different proposals wanting to join the NewOak family, and these tech guys, they essentially put up an app and they say, "Oh, I got it. Look, I can demo it to you." And then when we go through the FinOp and then the integration, the AML, the KYC, and say, "Oh, we're gonna deal with that." We'll hire an outside firm to take a look at it. A year and a half later, the bank is still keeping, in the meanwhile, they built a 20, 30, 40 developer team sitting there doing nothing, waiting for getting these issues solved. And we knew that day one, that should be your number one. So any fintech company that going into this and thinking that they're going to avoid regulation, they have something coming to them. The other fact is that the regulators don't know what they want. So you need to be ahead of them, and you need to be, frankly, give them the confidence that you are actually knowledgeable and you're very much in line. And this is taking a card out of the Larry Fink's book. Make risk your primary objective, because if you hang in there will be everybody else falling apart and you will be the last guy standing. And that is really what the fundamentals should be. So that's really the approach. And I will finish my comments saying that, look, we were a player at BlackRock in some of the most ultimately ended up being toxic assets. And guess what? BlackRock has never been sued for 1 penny. And we could have taken that asset class to 500 billion if frankly, because people would have trusted us with a lot of the money. But ultimately we end up with less than 10 billion bucks right before the crisis. And then after the crisis then it became 500 billion bucks because, Fed trusted their assets and whatnot. So if you're patient, it will come to you. And I really want to make sure that that is, and I think what's happening in your crypto world is that they're just trying to avoid, and they're trying, whereas regulation can be their friend, they actually are making a mistake by not being proactive about it. Because the feds, all these guys, you can buy them, you can get some administration to give you a break over a certain period of time, and you can make donations and whatever it is, but you're not going to get away. At some point, you're going to get caught, and the ticket is going to be very big. Goldman Sachs just got zapped for their not following their own ESG practices, right? They wrote the policy, they said it, they didn't follow it, and they got zapped for it. And that's not very good if you're trying to talk to your investors every day. So anyway, that's my, don't be afraid of the, regulation, because ultimately you want in your own company, and your investors want in your company, that you want to be a lasting entity, and keep that in mind.
I think that also ties in with the last panel to some extent, because what we're seeing, at least what I'm seeing a lot of, is early stage fintech companies. They come up with a great idea. They're trying to democratize capital raising. They're trying to and that's been kind of the big thing, is democratization, making things available to the masses, trying to go retail, trying to go gamification, trying to all of those types of things. But the problem, not necessarily the problem, but part of the issue is that there definitely is a mindset of, well, I'm an early stage venture company, not I'm a financial institution, and not that I'm trying to go ahead and build things up in through a compliance type regime, but rather grow so that way people can go out, we can go ahead and raise the B round and the C round. And I think that there's definitely a bit of a push and pull between being able to build in a manner that allows you to build a compliance infrastructure, with also growing quickly and being able to develop. But this is how a lot of the biggest fintechs in the world right now grew, like how Robinhood grew, how a number of other really big ones. So
there is definitely a discovery process, and some of the sectors are more mature. But let's talk a little bit about things that are more interesting, because they're really on the fringe of legality. And Daniel, this is
they're over the fringe.
It was either that or Borat was the barely legal. So we're just gonna go on with the fringe of legality. So what is the? Let's talk about. Exactly. All right. So let's talk about, some of the interesting sectors like cannabis space, right? Gaming and gamification, and even DeFi. There's a lot of discovery happening, on that end. So I will go to Andre. Let me ask you this question. And I know that you were in the cannabis space and no longer there, but I'm sure you're very current on it, or you can use another example if you'd like.
No. That's a great example, and obviously I was one of the early thought leaders in setting the bar in cannabis banking, and I helped about 30 institutions stand up their cannabis banking programs. So, when we start looking at cannabis, let's briefly talk about the federal regulations surrounding it. All right, it's federally illegal. And so that part's pretty simple. As far as federal guidance regarding cannabis, we had something called the Cole Memorandum, which came out, and basically it was a memo from the Department of Justice that stated, here are some enforcement priorities. And we've got other things to do, we've got other things to worry about. And as long as you are compliant with these priority factors, you're going to be off of our radar. And so that was kind of the operative document for a while. And then Jeff Sessions came in, and Jeff Sessions was no stranger to his dislike of cannabis. And so he rescinded that in early of 2018. Now, FinCEN came out with a guidance. Basically, it was on certain processes that a bank must do in order to support that industry, right? And so that's it. So we're still working with documents, if you can believe it, back from 2014. And here we are 8 years later, and we don't have any new guidance. All right, so that's why I'm sure you've seen about the SAFE Act. And so a lot of the bankers and fintechs are excited and they hope that will pass. Now that's been sitting around for a number of years and it hasn't gone anywhere. But basically it would not penalize a bank solely for being in the cannabis space. And so whether that will pass in the coming year or years is unknown, but that's always been on the outskirts waiting to happen. So when you start looking at the fintech supporting the space, a fintech gets caught up in this cannabis banking issue because theoretically, once they start making cannabis money and bringing in cannabis money, they become a cannabis company. They're a marijuana related business at that point. And so it can be difficult for the fintechs to get banking services even today. And so I started looking, and I got some numbers last night on some of the fintech cannabis companies. And now cannabis has been under fire in general, but the fintechs that have been banking that space, I pulled like 4 companies and looked at their stocks from high to low. And one went from $200 to 87 cents. There was another one from $10 to $3.72 in 2 months. And this was recent, so this just occurred. $27 to $1.23, and there are many examples of that. So fintechs are under fire, in the cannabis space, and all of their stocks, I won't say all, but most of their stocks have down, and of course it's been very difficult for them to obtain, new funding, and so that has been an issue. But when you start looking at the cannabis companies and those fintech serving the spaces, I see a lot of consolidation in the industries. And so whether, where you had numerous companies, all right, they're merging into others. So you have consolidation. A lot of the fintechs are going through layoffs. And so I know that's just kind of general to the fintech space, but especially, in cannabis as well. And cannabis has, I'd say 4 different types of fintechs that are involved in it. So you have fintechs that are bank facing, business facing, consumer facing, and then payments. On the bank facing side, there were dozens of companies that were saying, we're a compliance company for banks and credit unions, and we'll help you bank that space. And it was gone from dozens of companies to 2 or 3, at this point. On the seed to sale systems, those are like the point of sale systems for the merchants. It went from numerous, probably 30, 40, 50 different companies that were supplying that service to about 10. And then payments is a whole nother story. A lot of fintechs rushed in to try to offer payment solutions to the cannabis space, even crypto solutions. Oh, we'll use crypto to buy your cannabis. And nearly all of those have come and gone. So the credit cards are illegal per the rules, for the MasterCard Visa rules. So theoretically, if you're using a credit card or debit card to buy cannabis, that's against those rules. And of course, cash is still around, ATMs are still around, but the fintechs that are providing, I'm going to say, kind of the most common payment solution is a gray to black area. And it's something called cashless ATM machines. And so fintechs are providing these cashless ATMs to where, to the sponsor bank and to the world, it looks like a cash dispensing ATM. However, it's not dispensing cash. It's actually looks like an ATM, but they're using that to buy cannabis. And so all of the, I want to say, pretty much all of the electronic payment solutions for the cannabis space are pushing the regulatory, environment. And MasterCard and Visa, and they're saying don't do this, and they're slowly going after these fintechs that are in that space. But it's something that's more like a whack-a-mole. And so as soon as they squash one problem, and then another fintech pops up. So at the end of the day, the fintech cannabis space is still very, very challenging. There's not a lot of regulatory guidance around it. And until which time that we have more regs that surround that space, I think it's going to continue to be a volatile segment.
And the largely cash business, right? Sorry, I'm just having a cognitive dissonance just hearing cannabis banking. I was at JP Morgan for 7 years, so this still is something that I have to get used to hearing. Okay.
Oh, and one other interesting thing to note is that the early banks that got into cannabis, a lot of them were making pretty good money because they were the only show in town.
Right.
And so they were able to charge very high fees to those cannabis businesses, and they could get them.
Right.
As more institutions entered that market, in some markets, banks are leaving there, they're exiting because they can't make a profit in there. Now obviously there's some new states coming up, and there's still a lot of cannabis businesses that cannot obtain banking services. But it's even the banking side of it, can be a challenge as more businesses, more banks enter that space, and the pricing and the margins are getting smaller.
Thank you, Andre. Dan, what is your would you please comment on the gambling components and gamification? That's another area that's out there.
Yeah, well, I mean, I think there's a few different things that are kind of going on. I mean, cannabis it's interesting in large part because it has been expanding into so many different states and rapidly, and there's the various parts of it that are kind of in the gray area or even technically able to do so. I mean, I think what we're seeing a lot of, and in some ways this is more tech than fin, I suppose, but we're starting to see not only kind of casino gambling, but also within actual binary options, basically, essentially things where you're able to bet on the outcome of one thing that happens or not, which is actually something that's regulated by the CFTC, believe it or not. It's not, it's a CFTC thing, and they've shut down a number of people recently who have gone ahead and set up these quote unquote prediction markets. Right. And so the prediction markets oftentimes, so the rationale behind it at the very least is that predicting what's going to happen in the future is as a method of governance, essentially. And so that's something that people have been trying to kind of launch. They've been doing it through various types of tokens and crypto and stuff like that. But what we see is this crazy type of regulatory arbitrage that I think we saw with even FTX being in the Bahamas and other things along those lines where we've got I've had a number of things where people are either want to have gambling or have a gaming component to something that is financial, or conversely want to have a financial component to something that is gaming. Right. And so we're seeing, for example, a lot of Web3 video games that have a component where you can bet on who's going to win. You can stake your crypto on something. You can go ahead, and there are people who are developing and putting these types of things together. Now, can you go ahead and do this in the US? Probably not. I mean, and so what we see is people going ahead and picking and choosing not only jurisdictions, but also in some instances which regulator you're dealing with, because oftentimes there's more than one way to get to the same spot. And if you're trying to go ahead and get payments, well, you can do that through a bank. You might be able to do it through a money transmitter as well. And if you do it through a money transmitter, chances are you're not going to be looked at quite as closely by the people you're working with as if you're doing it with an actual bank. And so a lot of those types of things we're really kind of starting to see. And I guess what I would say is if you are looking into making an investment and that company is located in St. Vincent and the Grenadines, then probably there's some big gambling component that you don't know about, and you should be looking into a little bit.
Ron, let's talk about DeFi. Let's talk about DeFi a little bit, because there's obviously a lot of discovery that's going to happen in terms of regulation of DeFis. It seems that many are purposefully evading regulation and staying kind of trying to fly under the radar as much as possible. What is your view on this space? Or you can pick any other space to comment on?
Well, I think, the DeFi is used essentially very much in the fractionalization world. We heard about, wanting to own a piece of Van Gogh or
Right.
a piece of, in real estate, people were very familiar with real estate syndications back in the 80s, which was very popular. So the real estate syndicators would essentially buy a property, syndicate it to 8 doctors and lawyers, and or maybe even wider to much smaller. And at that time, they were they were not considered securities in their views. But then the SEC came around and said, no, you can't just sell. These are fractional. These are equity. You're selling essentially limited partnership or some shares, even though the underlying is real estate. So you can't just use real estate. So that ultimately ended up having to change majority of that industry. For example, I want to give you some other examples. I think folks who are in the family office are a little bit more relevant at home. A lot of real estate or a lot of family offices, they lead a deal and then they syndicate. And the view is SEC will take probably that syndication is, essentially you're selling LP interest, and therefore you're going to have everybody who's doing the selling be registered, right? I don't know how much of that you're seeing, Dan, out there, but I think that they're definitely going after valuation, after registration, after misrepresentation of. So you should be as one that you're really there to sort of, you found a good idea, you want to have a piece of it, but you also want to have your friends to have a piece of it. Think about whether you do need that FINRA coverage, if you will. I'm giving you, but anyway, back to DeFi. I think the DeFi will essentially are securities at the end, and therefore you do need to make sure, A, you're selling it, there's a fit. That means whoever buys it, you need to figure out which regulation under what act you're offering it. And essentially, we have at NewOak, we've decided it's a very good instrument to be able to disseminate information, to administer an asset, and to actually be able to, but we're going to use a Reg D type as opposed to anything else. So still, we go through the KYC and the qualification, qualified investors. But it is, as a technology, it is absolutely should not be put in the same spot as what is cryptocurrencies are.
Right.
And ultimately, I think what's happened though, you have people who are lending on these assets, and they take the exchange money and they put it into essentially lending on these assets, and people being bought. So you have seen unfortunately the poisoning that is going on from what I consider the value in exchange to real values. Van Gogh has a real value. A property has a real value. A trade finance has a real value. So that, I think, is, to me, my own personal view is that if you're going to do it right. Hire the right law firm, make the right PPM, and hire have the right broker dealer. We are in the process, as a matter of fact, having some of these fractionalization entities talking to our broker dealer to sort of create a special niche around that, so that you're doing it, in a very methodical way. And anyway, that's my personal view. Don't try to get around. Don't try to make sure that, oh yeah, this is not security. And I'm sure Daniel would have some very good comments on that.
Well, I think the one big piece of it is if you're actually DeFi, you need to be D as in decentralized, right? Like you should have, there should be a protocol. This protocol should work regardless of whether or not there's people who are there running it, right? in order to go ahead and actually be able to do things that way. And so there definitely is some DeFi out there that has, I think, very legitimate uses, and frankly, the way that the regulatory system is set up for it does not necessarily make a whole lot of sense, right? Because what you need to disclose if you're an SEC registrant is not the stuff that I would care about if I was going on Uniswap, okay, to be perfectly frank. And so, could there be a regulatory scheme that works? Well, people still need to program the protocol. You can build compliance into these programs. I mean, I've seen there's a bunch do people from Oasis Pro Markets here. I mean, that's what they do, right? is compliant crypto offerings in these types of ways. And so I think that there's a big difference between the people who are trying to do DeFi in order to modernize the economy versus people who are saying they're DeFi in order to avoid regulation, like the Uki DAO, for example, that just got in trouble with the CFTC. They were doing something that was clearly they had to be a swap execution facility if they were going to register, no question. And so what they said, oh, we're going to become a DAO and we're going to make it DeFi and we're not going to have a company anymore. And you know what? They're getting in trouble anyway. So that's one of those things where, I think there could be ways of doing it. Right now, I wish there was a lot more focus on regulators and legislators trying to make a workable system that actually makes sense for this, as opposed to trying to just enforce and have people guess what you're allowed to do and what you're not allowed to do.
My feeling of that is the wishful thinking. Regulators are not going to get ahead of this. If you want to bet on that, you have a lot better investments for you to look at. So the question is, figure out. I'm really baffled, for example, that some of the largest venture funds have gone to some of these investments, and they have not even been able to look at what is really in front of them. It's
remarkable.
It's unbelievable. I mean, it's just, I cannot believe that, what are these people getting paid, tens of millions of dollars a year kind of payoffs doing on their due diligence?
It's really telling you how they don't understand what they're investing in.
No,
right?
they're
So much
hiring
of
a
it is
guy out of,
momentum.
they're hiring, let's bash some of the universities, and they're hiring them. They 2 years as a venture at Cisco, and then bang, they're given control over go put in $1 billion to work, and the bigger the ticket, the better. That's it.
Julia, we have time for one question here.
Yes.
Yeah, I've got three, but I won't let you take one.
No.
So can I finish off with the last question, Marty, or is there?
No, you can't. No, we have to get to the crypto panel. But I do have a question from the audience here. And so, Anton?
Yes. You mentioned decentralized. What % ownership do you consider decentralized?
It's not owned if it's decentralized. That's the whole point.
Well, somebody owns something.
No, I mean,
No.
you have there's a protocol, and that protocol is sort of working a layer underneath everything else, right? And there may be a website, like a Web2 website that somebody owns that helps make it accessible to people who aren't coders, and don't know how to be able to access it kind of on their own. But the point is that you have something that's out there in the public. I mean, who owns Ethereum? Like,
There's no cap
you can
table.
own ETH, you can own the tokens, but
There's-
no, I mean, there isn't that's what you get.
70% of it was already owned by the original creator.
Fantastic.
Yeah,
So I'm going to leave that part of the discussion to the crypto panel. And you guys did a really fantastic job. Thank you so much.